Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is The Full Ratchet.
Eric Sippel joins us today from Berkeley. For over 25 years, Eric has run his family office, where he has invested in more than 30 emerging managers. Prior to running Sippel Farb, Eric was a hedge fund and VC investor. Eric, welcome to the show.
Thank you so much.
So very quick background there. Can you sort of give us the 2 to 3 minute overview of your path to Sippel Farb?
Sure, of course. And before I do that, just a little perspective. So what I like to do when I invest is I invest both time and money. So when I talk about my path, you'll see how that sort of makes sense. I started off my career as a Wall Street lawyer working for our firm's private equity fund clients. After 4 years, moved out to the West Coast, where I co-led a nationally recognized hedge fund law practice, and I did a bunch of venture capital work. And then in early 2000, left to join a spin-out of one of my clients out of Robertson Stephens as a hedge fund as the COO. And then ran their venture practice, which wasn't very good, by the way. And then I was the COO of the firm. We grew the assets to several $1 billion. And we all realized that we were done investing other people's money. And so we closed the firm in 2010. And since then, I've been a philanthropist and just investing directly as my family office, again, investing time and money. Started investing in the venture space back in the early 90s.
Very good. And can you give us a sense for your investment focus at the family office? What assets do you invest in and kind of what's the breakdown there?
I'd say about a quarter of the assets are in commercial real estate, a quarter are in public equity, a quarter are in fixed income, 15% is in venture, and 10% is in miscellaneous. But that's in terms of money. In terms of time, 90 to 95% is in venture.
Wow. Awesome. And maybe that's a good place to start. I'd love to hear a bit about the evolution of VC from your standpoint and investing in emerging managers over the past, 25, 30 years.
So let's start at the end, and then we'll go to the beginning and talk about evolution. There is, in the last 3 to 5 years, there's been just an explosion of emerging managers in ways that are just sort of off the charts. And so now let's go back to the beginning. Back when I started investing in the early 90s, there just weren't that many firms around. And it was hard for emerging managers to break in. Seed wasn't really a thing as its own, and really established players were playing in the early stages. And it was hard to get there. Everything cycles. And so up and down in terms of performance and the environment and the like. We fast forward to 2012, 2013, and all of a sudden you have a whole bunch of operators who are successfully coming into the field. And then, as I said, 2015, 17, you have just truly an explosion of so many talented people coming in.
Yeah, it's changed quite a bit. How about on the family office side, right? You've been at this for a long time. Can you give us some thoughts on how family offices investing in venture, how that's changed over the 25 years you've been doing this?
That hasn't changed quite as much. Certainly, there are more family offices investing now than there were, but family offices are all different. So there's no one way a family office does anything. And so it's really hard to generalize. But for the most part, family offices are constrained by their network. Which funds come across their desk constrained by their network. And so I'd say that family offices are changed a lot less because it's just hard for many of them to get comfortable with deal flow and with quality because they just don't see enough. I mean, and they see plenty, but they just don't see the range.
Right. I do want to talk about that a bit later. Maybe we'll start out. I think the old cliche holds that, you've seen one family office, you've seen one family office. So, Eric, I think you can speak for yourself, maybe not for everyone. So let's start there. Talk to us about manager selection. You're meeting new managers, you're meeting an emerging fund. What gets you excited when you sort of review the profile and hear the pitch for a new emerging fund?
Well, let me walk you through my rubric. So in terms of how I think about it, and what gets me excited is if a fund ticks off all of the boxes in the rubric. I start at the highest level, which is what space are they in, and is it inefficient? I just don't think that you can make money consistently investing if you invest with crowds. And so I'm looking for inefficient sectors. And in venture, that's expressed usually with diligence periods and with valuations. But it also is just how many investors are there in that space and what's the opportunity in the space. So I start at that level. I get next to general partner experience. At a minimum, what I'm looking for is, and not every manager will fit all of this, I'm looking for a minimum of at least 5 years of operating experience in industry, in the same industries that they're going to invest in. And then at least 5 years of venture investing experience that is comparable to what they would be doing with my money. So that's the second level. The third level is what I call the craft of venture investing, the 3 S's. Sourcing, which is, I guess, sourcing and winning. Selection, which is how you do your diligence, how you analyze companies, how you select companies. And then stewardship or value add, how you help companies to perform after you've written the check. And then lastly, portfolio construction. For me, and there's a big debate in the venture world, but for me, I like high conviction, high concentration, large ownership position investing. And in particular, I'm also attracted to seed stage because I can accomplish all of that.
Good. So on the first point, what is an inefficient space or sector? It sounds like it manifests in maybe, better valuations and longer diligence periods, but can you give us an example of, an inefficient space that was interesting for you?
Well, an example would be hard science that's being spun out of universities. So I don't mean AI or anything digital, but things like little mechanisms that will prevent vibrations in lawnmowers, or little sachets that you put into produce boxes, things like that. So technology that's just a little off the beaten track. There are very few investors who are in that space, in part because it's really hard to do well. And so that's an example.
Very good. And then on that second point, the 3 S's, sourcing, selection, stewardship. Are you looking for sort of unique angles on each of those, or some sort of edge? As many LPs have come on the program and talked about this mythical edge. Like what with each of those 3 categories are sort of you looking for?
Focus in reverse order. I triple click on stewardship, I double click on selection, and I'll single click on sourcing. And why don't I go through what I mean by that? To start with, there are lots of fund managers who just don't even really pay attention to adding value afterwards. It's just not what they're set up to do. That's fine. That's just not an area where I want to invest. Doesn't mean that they're not really successful. It just means that it's just not for me. And for me, the reason why I look at it this way is I'm trying to distinguish between skill and luck and find managers that I think produce sustainable returns. And so the ability to do that, I find that stewardship and the value add to companies really helps distinguish the sustainability of returns and as part of the skill piece. Now, what I would say on that is it's one thing to say you do that. It's another thing to really dig down and find those that do it well versus those that do it poorly. For me, customer intro is a really important value add piece because I think some do it well and many say they do customer intro, but they don't really know who. They know somebody who works at a company and they introduce the portfolio company to that person and they get passed around and nothing really happens. So there's an art to customer intro. So anyway, that's sort of value add. Selection, I double click. For me, being in the investing world for 30 some odd years, I have a good sense of when people are thorough about their diligence versus just doing it at a cursory level. And I like to see what people think and how they analyze things. So that's the double click. The single click is sourcing and winning. And the reason why it's single click is because everyone says they have a network. And, how do you test how strong someone's network is? And there's also a problem where I just need the fund manager to find and choose 15 investments, maybe 20 over the course of 3 years. I don't need them to see everything and have a huge wide funnel. I need them to be good at these other things. And what I find is that stewardship in particular will predict selection because it will predict who your due diligence sources are, and it'll predict sourcing and winning, because typically entrepreneurs and founders who rave about venture capitalists will also be really helpful in terms of referring new deals as well as being references.
I found it interesting over the years. I've been hosting this podcast for over 7 years now, and I've seen the venture industry evolve quite a bit, right? From hundreds of funds to now over 1,000, right? 1,500. And also the way that funds differentiate has changed, or at least the emphasis. It seems like now all people talk about is sourcing and winning deals. Yes. And sort of the speed with which they can make decisions. Whereas back, when I started the show, the first 3 to 5 years, it was just all about the selection process. There was so much art and science and quantifying the qualitative and so much that went into the art of selecting winners. And now it's really about speed. Can you source really talented teams working on big opportunities? And then can you get to decisions fast? I'd be curious to hear your take on that. And, if you've also observed this, speed over everything and short diligence cycles.
Yes. Unfortunately, yes, I have observed that. So one of the early questions I ask a manager when I talk to them is, what's your typical period between the time that you meet a founder and the time that you write a check? And those managers that brag about how they can do it really quickly, I know is a no right off the bat. And there's a huge number of funds that sort of do that and are proud of that. So yes, I think it's a horrible trend in the business. When you write a check in the venture space, you can't sell that position. You're married to that company and that founder for 10, 15 years. If you don't take the time to figure out if that's a good fit, both on a personal level and on a coaching level and on whether you really think that's a great investment, you're not a manager for me. The thing that I like most is very long diligence periods, but I particularly like fund managers that introduce potential customers to portfolio companies before they write the check. And then their decision as to whether to write the check or not is in part based on the feedback they get from those customers and how the founders deal with that feedback. Because it doesn't mean just because they didn't sign up as a customer doesn't mean it's not a place that you want to invest in. It does show you, all right, well, how is that feedback going to be taken? What are the explanations, et cetera? And that takes time. In the deep tech space, it takes time to test the technology. My ideal funds are the ones that take 6 to 18 months to make a decision.
Wow. Interesting. I love the point around making the customer intros. It's always a huge win when you see a founder that is really receptive to feedback from the customers and they want to work with the customers, and even better when the customers are so excited about what's being built that they can't wait to become a customer. It ends up, being a huge win for our diligence process, and then also for the startup as well. Yeah. Eric, I guess I also kind of wanted to get your opinion on why a more concentrated portfolio, right? Why higher ownership positions? Why not? I mean, people in a pejorative sense may call some approaches the spray and pray, but why your emphasis on more concentrated instead of, a more diversified, high volume portfolio? Sure.
And let me back up. For a fund, if your strengths are in a more diversified portfolio, you should do that. It's just not necessarily going to be from me. So there could be plenty of people who are really successful with broad portfolios. So there are several reasons. Number one is maybe the primary reason is capacity. So you have the capacity to review a certain number of deals well, And the more deals you have that you are reviewing, the harder it is to analyze and investigate those companies. That's number one. Number two, once you've written the check, again, remember that I triple click on value add. It's really hard when you have a lot of companies to add a lot of value across all of those companies. And so you add that up and you're much more likely to get better investment decisions and portfolio companies with more value added to them when you have a smaller number of them. So that's number one. Number two is, for me, this is a sort of a high ownership. This isn't necessarily around concentration, because you could be concentrated with small ownership. And this also relates to fund size, and it's around portfolio construction. I'd like to see each investment have the possibility to return the fund. Now, I have some investments that are Series A funds that are a little bit larger, and I recognize that that's not necessarily going to be the case with all of the investments that they make. But for the seed stage, which is where I like to focus, I'd like to see each investment be able to return the fund. Having high ownership is important for that.
Got it. If we take a step back, think about family offices. Again, you can't speak for all of them, but when a GP is pitching a family office, not just yours, talk about what they should be mindful of that may be different than when they're pitching, let's say, an institution.
So a couple of things. I guess the one thing is typically it's one decision maker, two decision makers. It might be the person working for the decision maker, or it might be the person you're talking to might just be the decision maker. And so process is very different from a family office perspective. You're not going to have committees generally that you have to sort of satisfy and weigh. You're not going to have sort of, as the guidelines aren't going to be quite as strict typically. What that often means too, when you make an investment decision, you make it both based on financial and emotional reasons. And there may be, the personal connection may be stronger in the, with the family office as leading to closing the deal than it is with endowments or foundations or other institutions. So that's a big difference, I think, from my perspective. Many family offices, I alluded to this at the outset, many family offices don't see big deal flow. And so they may be more persuaded by who the co-investors are in the fund than certain endowments or foundations, although there's certainly some of that goes on at every level. So that's another thing I think you sort of have to keep in mind. And the last thing is, family offices usually have made their money in a particular industry. They can be pretty helpful if you're investing in that industry in terms of being a sounding board and in terms of customer intro and the like, and talent intro. And family offices like it when they're consulted. They like it. They like to give back to the fund manager if they're going to write a check. And lots of funds miss out on that opportunity.
What about the family offices that prefer, co-investment? I'm not sure how much you do of that, but, I've interacted with a number of families that have said, yeah, really interested in the fund, would love to see some direct opportunities first and work on those. And then potentially, if I become a fund investor, would love to co-invest alongside you or, in your follow-on pro ratas.
I have so many different feelings in that, some of which will be controversial and won't necessarily put me in good stead with other family offices.
That's what we're here for, Eric.
Yeah, I guess. So first off, I don't do any co-invest. So Start there. And yes, lots of family offices are looking for co-invest. They're looking for ways to drive down fees in many instances. Again, you can't say in all instances, but in many instances, these family offices are just making bad investment mistakes. They don't have the skill set that GPs have. They don't have the network necessarily to diligence and investment that GPs have. Now, of course, if you were in the industry, if you grew up in the industry as a family office that you're then co-investing in, I take that back, of course. They don't necessarily have the capacity to correctly analyze these. There's adverse selection where Oftentimes what's available is not necessarily the best investments. And so I just think it's a huge mistake, even though you drive down fees, to write checks alongside, as a co-invest or a follow-on invest with a GP, unless you can figure out the very highest conviction follow-ons that GP is doing, not all the follow-ons, and you can figure out, and you have a diligence edge that will help you out there. Otherwise, I think it's just a mistake. Now, I also think it's a mistake on the fund manager side to offer co-invests to somebody before they become an LP, unless it's somebody who's really going to move the needle for you and you think they're close to investing. And so you just need to do one co-invest with them before they write the check. Otherwise, I think that's a mistake as well.
You hear this old cliche about, somebody goes to Vegas, they hit it big, their first time, and then they keep going back and they're losing. And I've seen a similar pattern in some cases with family offices and angel investors. They get lucky, with like an early deal, or maybe they were good. I don't know. But, they have a big hit early, and then it makes them really want to double down on directs and put, far more allocation into individual investments than maybe the standard diversified venture portfolio would warrant.
Yeah, I just think that, as an investor, whether you're a family office, you're an institution, whatever it is, you have to know what you're good at. You have to know why you're good at it. And when you have that self-knowledge, you can then apply it to where you're going to invest your money. And you have to be honest with yourself. And you have to look at your track record over time.
100%. Family offices are a bit opaque, right? It's hard to find them.
Yep.
It's hard to know what their investment interests are, what they're good at, what their specialty is. Do you have advice or suggestions for ways that fund managers can find and connect with families that may be a fit for them? And have you seen any strategies from GPs that have connected maybe with you in, creative ways that, you were open to?
Mm-hmm. So there's lots of different parts to that question. Let me see if I can break it apart. So finding family offices is hard. As you said, it's really hard. There are some places that I think are easier than, or some places where you can find them. So number one, I think Raise, the conference, does a fabulous job. I was on the selection committee for a couple of years, and they do a fabulous job of connecting emerging managers and family offices. There are some of the large banks that focus on venture investing, like First Republic is the one that comes to mind, does a great job of connecting family offices to GPs. So some of those things I think are ways to do it. There are some other things out there as well that are helpful, some other conferences. So that's sort of on the how do you find them piece. The other way most funds find me are just through my network. I have great network in the fund-to-fund space, a few endowments, other family offices. They'll send me things that they find are interesting. I'll send them things that I find that are interesting. And so that's the typical way things are, people find each other, but that's true at the institutional level too. It's not just a family office thing. So that's in terms of finding each other. In terms of connecting, what I would say is really important, and GPs often sort of lose sight of this, is trying to have a conversation, getting to know the person before they get to a pitch. Sort of exploring what their background is. I mean, the first question, it should be the GP asking the LP, tell me about yourself. Tell me about your background. What other funds have you invested in? What are the things you like? What are the things you dislike? So that there's sort of a connection. You'd be shocked at how many GPs don't actually look at someone's LinkedIn before the LP's LinkedIn before they talk to the LP. So that if there's something on the LinkedIn, like, for example, I was a soccer coach for many years. So, people like soccer, they'll connect with me around soccer. Or I am the chair of Bay Area Goodwill. And so people who have a connection to Goodwill might talk about that. It's sort of doing a little bit of homework and finding out about the person and trying to connect on a personal level before you dive into the pitch.
What mistakes do you see emerged managers make, right? We've talked a lot about emerging managers. How about emerged?
I think emerged managers and that's again a broad category. I think oftentimes they get too large. Their fund size grows too large. That means that their selection process gets sloppier. Their valuations process gets sloppier. If they're writing bigger checks for the same size ownership position, so that's one thing that I think emerged managers do poorly. The other thing I think they do poorly is sort of maintaining quality, not just in the way I just described, but also, when you grow assets, you have to grow your team. You often lose the true strength of the firm as you get really large. You really dilute, the true superstars. And so I see that as a big issue as well. Obviously, there's some very large, very successful firms, and so you can do it well, but I think it's harder. And then culture becomes harder, and investment committee becomes larger, and you have all of those dynamics, and it's hard to go from $100 million managing $100 million really well to ultimately managing in a fund to a $500 million or $1 billion fund. Those are hard. It's hard enough to go from 100 to 250 million. So those are the things that I see, and most people kind of ignore it until it's too late.
Interesting. So as these funds grow and stuff, they become looser with the thesis. And I'm sure a lot of firms, the thesis evolves over time. How do you
less about the thesis. It's more about the quality of the diligence, right? It's more about the risks that you're willing to accept, because you have, when you can only write a small number of smaller checks, and everything depends on it, you're just going to be that much more, have much more of a critical eye than when you have a huge pot of money at your disposal. And when you have a larger team, you have to do things like, oh, well, I have to make sure that team member is happy, and so maybe I have to say yes to that deal when I shouldn't say yes to it. And it's just around, it's not sloppy, because I don't think it's sloppy. I just think it's a little bit less sharp, if that makes sense.
Interesting. So how does one manage that, right? Both the GP and the LP investing in the GP.
So my favorite way to manage it is to stay small. Don't add a lot of team members. Yeah, you add a couple to support, and don't add a lot of assets. Just stay. If you're really good at managing 100 million, why do you think you're going to be good at 300 million? Just stay at 100 million.
Good point.
So go to 120, 150, and then stop and be done. And go and grow really slowly, because your fund size is your strategy. And so just because you're good at one doesn't mean you're going to be good at the other.
So there's a great piece on Substack by Nikhil Trivedi that discusses the rise of the solo GP. What are your thoughts on sort of, the increase in angels, super angels, solo capitalists? And do you see this as a threat to traditional venture firms?
I think it's great. I think it's fabulous. Again, you need to know what you're really good at. You need to you adjust your fund size so that it fits that, and then off you go. I don't think it's a threat when you have really talented people funding companies that need to be funded.
How about the difference in models, right? There's all these different types of ways of investing, right? You've got your traditional committed fund, but now, there's been a proliferation of SPVs, syndicates. We have rolling funds. We have opportunity funds. How does an LP navigate sort of all these different structures and ways of participating in the asset class?
It gets back to what I was saying before, which is you really have to sort of be immersed in the asset class to understand the nuances. And what's different. So, for again, family offices, there are many family offices that are immersed and understand this, and then there are lots of family offices who, this is all Greek to them, and that's fine. And if it's Greek to them, they should not necessarily try to engage with it. But I love opportunity funds, and I don't like SPVs. I don't like rolling funds. I like traditional drawdown commitment funds. That's just me, and I have reasons for it, but those other ways of doing it are successful for a lot of people. And if it fits their strength, as the GP or venture capitalist, if it fits your strength, you should go do it. You really need to fit your strengths to your structure.
Perfect. All right, Eric, this question is called 3 data points. I'm going to give you a hypothetical situation with an emerging GP. You can ask me 3 questions for 3 specific data points in order to make your decision. Okay. So that the fund is based in the Bay Area. They're raising $50 million. They invest in seed and pre-seed rounds, and they do not have a sector mandate. They're sector agnostic. Again, the catch is you can only ask 3 questions for 3 specific data points in order to make your decision. What 3 questions do you ask?
To tell you my decision's no, but I'll ask the question. So number 1, where are most of your portfolio companies located? Number 2, how long from the time that you meet the founder until you issue a term sheet? And number 3, the cheating one would be, what haven't you told me that I need to know? But that I won't ask the third question. The third question will be, what excites you?
Very good.
But the answer is, I don't like generalist funds, so I probably wouldn't invest in this just to start. Bay Area funds, if they're specialist funds, I'm interested in. But Bay Area doesn't disqualify it. But no, the generalist no sector mandate does.
Okay. What if the answer is like, where are most of your portfolio companies? Let's say they're spread all around the world. Let's say if it's 6 to 8 months to term sheet, and what excites you? Let's say it's deep tech, really nuanced. Let's say heavy science oriented tech.
I view that as a specialist. Deep tech I think of as a specialty. So I am invested in probably the largest number of funds I'm invested in, and both in terms of capital and number of funds, is deep tech funds. And so I think of that as specialist, and those are all really interesting to me. So 6 to 8 months, you've described a bunch of funds in my portfolio, but 6 to 8 months, deep tech around the world. Yeah, I'm very interested. We can have a long conversation. We're probably going to talk for a while.
Very good. I'm curious, are there signals post-investment, after a certain period of time that indicate to you that a GP or a fund is really working well and gives you sort of the conviction to re-up for the next fund?
Lots of signals. Now, for me, when I underwrite a fund investment, I'm usually thinking that unless I see something that really bothers me, that it will be that I'm investing in at least 2 funds, and my hope is I'm investing in every fund in their life cycle. So, and what I try to do is I try to mentor the managers where I've invested and try to add value. My goal is to be the most value add LP that the GP has, and so I have the ability to stay close to people and learn what's going on. So, what are sort of things? So, the thing that most people look at that I think is least predictive in the first 3 years of a fund is track record, right? How is a portfolio, what are the markups? Because there's so many other external factors that relate to that markups aren't necessarily the best way to think about things. Portfolio company progress is really important. So if you can look underneath the valuations to see the progress, that's really helpful. For me, it's important that the GP do what they say they were going to do during the pitch, but also evolve as the environment evolves. And so they don't have to, it's an example. If they say, all right, we're going to have long diligence periods and they have short diligence periods because they can't get into deals otherwise, I get that evolution. That's fine. It doesn't work for me because I don't like the result. But if, on the other hand, they say, instead of, we have a long diligence period, but instead of owning 15%, we own 12% or 10% because we want to write a larger number of checks because we have a much wider opportunity set and we have the capability of doing that. that's fine with me, right? So it sort of depends on why they're evolving and and what the environment is. The other thing I'm looking for is, and this is a mistake that a lot of managers make, I'm looking to see where they follow on with their capital. And so I think follow-on capital is the most valuable thing you can use. So are they following on into the things where they're supporting all of their companies? That's okay. I don't love that. Are they writing much bigger checks to the companies that they think are true winners and true breakouts? I really do like that, particularly if they can do that before the rest of the world sees the inflection points. Are they supporting the losers because they're afraid of companies that will, without their support, they won't make it? But they're not really likely to return, be significant winners for the portfolio. Those are the kinds I really dislike. So follow-on strategy is important for me. I love to go to annual meetings and talk to founders in person, because then I can find out how much value the GPs are adding to the companies. And I like to add value to the portfolio companies where I can, because again, I can find out more about the GPs. So those are some of the things that I'm looking at and looking for.
If you see a follow-on strategy that includes, bridging or, helping some of those early companies that haven't quite gotten to the next level yet, is that going to be, a negative signal for you?
No, it depends on why, right? I mean, a lot of times if the company's hitting milestones or coming close, doing the things it said it was going to do, you still have just as much conviction in the company as you had when you wrote the check or close to it. A bridge is a great way to increase ownership before everyone else sees it. It doesn't have to hit takeoff velocity yet to write checks into follow-ons. On the other hand, if you're writing the bridge because you think that somebody's going to come along and buy the company at a 1.5x rather than a 1x in a year and a half, the risk of that not happening is high enough that I just don't know that that's going to be a strategy that makes sense to me.
Eric, what advice, maybe, something we didn't cover today, what advice would you have for GPs out there that are raising, fund one or fund two?
I would, and it's not necessarily funds that are in the process of raising, but I would always think about your communications with your limited partners as being the foundation of your next fundraising, of the next fund. And so number one is it's much easier to retain your existing LPs than it is to go out and find new LPs. And so you want them to be happy. You know that in the investing world, lots of things will go against you. You don't necessarily have the luxury of timing your next fundraising for when things are going well versus poorly. And you know that for the most part, people look at markups. And so how do you change that conversation and reframe it so that you're communicating with LPs in a way that makes them comfortable with re-upping? Or in the case of new people that you've met, how do they look at what you've done in a way that is not just based on markups? And so how do you communicate portfolio progress? Whether it's new customers or milestones, how do you communicate, that you are doing what you said you were going to do? So lots of GPs say they add value to portfolio companies. Don't just tell me that, show me it. Give me examples of that, both in the fundraising process as well as in your LP letters and annual meetings and the like. If there are other things that are, around your strategy or your thesis or just your pitch, make sure that in your communications that you're communicating that so people are like, oh yeah, they're doing what they said they were going to do, as opposed to just sort of ignoring it and starting from scratch again. Because if I have to come back up to speed for the next fund and the fund after, because I don't know that you actually did what you told me you were going to do, it's harder for me. So that's I think the biggest thing that I would say. The other piece, while you're fundraising, think about your data room as, kind of the way you would think about footnotes in a paper. So, in your pitch deck and in your pitch, you say certain things. Again, let's just use the example. I introduce customers to portfolio companies before I write the check. Use the data room to highlight that, to show examples of that, so that I don't have to go out and talk to 15 or 20 different references to prove the fact that you did that. It's all in there. It's in the data room.
Perfect. Super helpful. Eric, if we could interview any guests here on the program, what guests do you think we should feature, and what topic would you like to hear about?
I'd love to feature Warren Buffett. And I'd love to, and not because I want to hear about what he thinks about technology investing, but I want him to think about, what do really strong investors do that can carry over to venture.
Love it. You're not the first to request that. We'll get right on it, Eric. And then what do you need to get better at?
Oh, gosh, I need to get better at everything. Yeah, there's so many things that I need to get better at. I need to get better at asking better questions. I need to get better at digging deeper. I need to get better at, I need to get better at sort of distinguishing between what seems good and what is good. I need to make sure that I continue to try to avoid FOMO. I mean, it's just, when you're an investor, you never stop growing. I'm lucky to do this because it's really fun, but I mean, there's so many other things that I can learn.
And then finally, Eric, what's the best way for listeners to connect with you and follow along with Sippel Farb?
Connect with me on LinkedIn, and then, we can go from there.
Well, very good. Well, Eric, I appreciate you doing this. I'll say from personal experience that in the broader LP community, you are one of the most thorough and helpful people out there. I've really appreciated our interactions over the past few months, and I really appreciate you sharing your thoughts and your advice with emerging GPs today. So thank you.
Thanks, Nick. I appreciate it. This was fun.
That will wrap up today's episode. Thanks for joining us here on the show. And if you'd like to get involved further, you can join our investment group for free on AngelList. Head over to angel.co and search for New Stack Ventures. There you can back the syndicate to see our deal flow, see how we choose startups to invest in, and read our thesis on investment in each startup we choose. As always, show notes and links for the interview are at fullratchet.net. And until next time, remember to overprepare, choose carefully, and invest confidently. Thanks for joining us.